Hello everyone. Today I am going to begin with a new topic which is capital structure from your financial management subject. Okay. Now, as we have already done a little bit of introduction of what is financial management, what is capital, how to find a cost of capital, what a company is looking at, when they are going to invest in a given project, what are the other costs involved, what are the earnings given to the equity shareholders, everything we have seen in our previous topics. Okay, capital structure revolves again around the same thing. Okay, capital, the name of the topic itself is capital structure. Okay, now structure over here is nothing but it talks about that a company can have a combined structure. Certain companies may have equity share capital only, no debt. They can have some capital, some debentures, some capital, some in form of loans. Okay, they can also have it in the form of, say, capital plus reserves. Okay, they can also have preference share capital, or they can have a bank loan. So this is a structure which an organization, which a company can apply to and have their capital in place for the corresponding assets and projects for which they want to work into. Okay, now as a company, if I am doing a financial management of the company, how would I know that what is going to be the best structure? Any structure we are free, to apply or, have it. So which is going to be the best one? Should I go for all debt? Should I use my reserves? Or should I have equity share capital only for the future if I want some expansion plan? Okay, I have some expansion plan in front of me and I want to increase my capital. What is going to be the best, the optimal capital structure? Okay, that is what we are here to decide about the capital structure. So, in short, what is a capital structure? I will take you all through the theory notes also. It is the entire capital employed of a company. Okay, so basically we are talking about the capital employed of the company. That capital has a breakup. Okay, we had seen it before in cost of capital also, right? That capital has a breakup. It can be in form of equity, preference, debt, reserves, which has each cost involved to it. Okay, so say if I am telling you a company has 50 lakhs rupees as the capital employed, and in that they have equity 25 lakhs, they have preference share capital of 5 lakhs and 20 lakhs in form of debentures. Okay, so this is their capital mix which they are having currently. So whether this structure of 50 lakhs in this form of division, whether it is giving my investors, okay, good earning per share, okay, or giving them a better market price, are the investors, are the owners happy? Okay, how much is the price earning ratio for the investors? So if I want to invest in a given company, generally when I am doing the analysis of, before investing or taking or buying the shares of the company, I see their price earning ratio. Okay, how much time, okay, the price earning ratio is there, how much time it will take my earnings, how many times I will have to earn from the company in order to reach the market price today. Okay, so I would like to see that price earning ratio, and that I am going to get only from the help of the financials of the company. Okay, their structure, their profit, okay, how much cost is involved with their capital also. Okay, so investors always see how much earning they are going to get, what is the market price currently standing, what is the price earning ratio. So all this we are going to do in this chapter. Okay, now how will I know how much is the earning per share? We have done this income statement before also, and we are going to do it again. So you all are going to become master for this income statement because we are repeatedly doing this. Okay, we had done it in leverages. So leverages is a part of capital structure. Okay, So income statement we all know, NPBIT, okay, minus the interest, you will get net profit before tax, less tax, you will get net profit after tax, minus the preference dividend, we will get profit available for equity shareholders. We divide that profit with number of equity shares, we get the earning per share. So if earning per share is given, if market price is also given, so price earning ratio is easy for us to find if they have asked for the same price earning ratio, right? So all this we are going to do in order to see how much is the EPS in a given capital structure. Okay, now one very important thing is, for capital structure, in order to get a good earning per share, don't you think my NPBIT has to be good? My return. NPBIT is what? Basically, it is the return on capital employed, na? Whatever is your capital, you are doing business with that capital. Buying assets, assets are working, and therefore you are going to get sales and then you have profit. So your NPBIT is basically the returns you are getting on your capital employed. Okay, so if I am saying that my capital employed, okay, is 1 lakh, all right, existing, okay, and my NPBIT is 10,000 rupees. If I am saying my 1 lakh capital is giving me an NPBIT of 10,000, so what will be my return on capital employed rate? 10%, 10,000 divided by 1 lakh, I am getting 10%. Correct? So say in future I want 1 more lakh additional capital. Okay, I want more 1 lakh of capital. I have to do some business with that capital. Okay, so this is my additional capital. I need it. Will that make to 2 lakhs? But I want my return to stay the same. There should be no difference in my return. So if I want to keep my return the same rate of return, now my new NPBIT will be how much? 20,000, 10% of capital employed, which is 2 lakhs. That means if I am going ahead and employing 1 more lakh of capital, I have to earn a profit of 20,000 to keep my rate of return on capital employed the same. Okay. Now why am I explaining this and why am I telling you this? Is only then we will be able to find the optimal capital structure. If a rate of return does not get affected, it is only then we will be able to see that okay, the revised capital which we are having either in form of equity or form of debt or form of preference share, okay, which will be the most optimal if we don't change our rate of return. So in all the sums, when you are going to solve a practical question, they will not give you the NPBIT. Okay, we will have to find the NPBIT with the help of the rate of return. Clear everyone till now? Okay? Yes. All right, fine. Okay. So, here, capital structure. So we just did what? Meaning of capital structure. It is the breakup of the capital employed by the firm. It is a reflection of the overall investment and the financial strategy of the firm. Okay. So this types of capital structure, okay, horizontal, vertical, that I am going to take it separately when we are going to do the entire theory of FM separately. Okay. So these are the ones which can be asked in your question. May it be an MCQ paper or may it be a written paper. Okay, while they are asking you a question to be solved, in that they might ask you, please explain optimal capital structure. Okay, briefly, 3 points. So from all these points you can take up the 3 points. Okay, so what is an optimal capital structure? Basically, it is a mixture of a debt and equity in such a manner that it will maximize the value of the firm. Value, okay, will be maximum, and the cost of that capital will be the minimum. Okay, that is known as the optimal capital structure. Okay, weighted average cost of capital entire is minimum at that level. Okay, so combination of that capital, which will give you the, even the company should have an optimal debt to equity ratio. Only then, if this is there is a optimal capital structure, means what? The best of debt and equity in such a manner that the ratio maximizes the value of the firm. Okay, now for a capital structure, one will need the requirement. How much is the company requiring? Availability of different components, which structure, like, or which kind of component, capital component can you take up? Equity or debt, whether it is available, bank loan available, not available, cost and the return from that investment. Okay, then difference between capital structure and financial management, this is there. EBIT we have already done it right now, and we will do it while solving the sums. Okay, now I want to take you all first to first type. Okay, only then we will be able to understand the other theory. So let us first go to type 1 in order to get the basic understanding of what is capital structure. Okay, now in type 1 what will happen is, they will just give you the basic information. They will tell you the present capital structure is so and so. Okay, they will give you the information on the present. They will tell you about how much additional funds are needed, and then we have to choose the correct option to raise the funds. That is, either it can be in form of equity, debentures, preference shares, or mixture. Okay, what should be done? So they will give you existing, they will give you additional funds requirement, and then they are going to tell us then which should be the correct option. They are going to give us 3-4 options. Okay, now let us read the sum. ABC Limited has equity share capital of rupees 5 lakhs, face value is 100. That means there are 5,000 equity shares currently in the company, right? To meet the expenditure of an expansion program, company wishes to raise rupees 3 lakhs. That means they need this additional money. This is their existing structure. It is having 4 alternative sources to raise the funds. Option 1, they can either do it full money from equity shares only, or they can have 1 lakh from equity, and they can do 2 lakhs borrowing at the rate of 10%. Okay, full money in form of borrowings only, 10%. Full money they take a loan. And the fourth option is 1 lakh in form of equity and 2 lakhs in form of preference shares, where dividend rate is going to be 8% per annum. The company is having a present NPBIT of rupees 1,50,000 and their corporate tax rate is 50%. So suggest the suitable option to raise the funds. The company wants the same return as earlier. Okay, same return as earlier. In the question they can give you a new revised return. So then we will take that. But otherwise we always, if nothing is given, that means we are supposed to maintain their rate of return on capital employed. Okay. So how will I, first I will have to find the rate of return on the capital employed. So Okay. I will solve this sum with you all so that you all get a understanding. Sorry. Okay. Question number 1. Okay, first I have to find my return on capital employed. This is my important thing. Okay, so they have existing capital employed. They have an NPBIT. With that I can find the rate of capital employed, return on capital employed rate. What is the existing capital? Can anybody tell me? 5 lakhs? Existing, against which they are earning an NPBIT of 1,50,000 here. Given both things, both the figures are given 1,50,000. So the return on capital employed will be what? NPBIT divided by capital employed. 1,50,000 divided by 5 lakh %. So it is going to be 30%. I need the same return with the revised capital, which is now going to be 5 lakhs plus 3 lakhs. How much it is going to become? 8 lakhs. On 8 lakhs, 30% is going to give me 2,40,000. Everybody clear till here? Understood? Yes or no? Okay. Fine. So see here, I have already solved it for you all, but I wanted to solve it again and show it to you. Okay, now they have given me basically 4 different options, right? 4 options are given to me. In that 4 options, I have to first make a table, particulars, option 1, option 2, option 3 and option 4. Okay, I am going very slow. This is the first sum. I want you all also to do it along with me. So I am going a little slow with this sum. Okay, because then the other sums are the same. Now I have found my revised NPBIT, which is 2,40,000. So my return on capital employed being 30% and my revised capital being 8 lakhs, my profit before interest and tax will remain 2,40,000 across all the options. This is not going to change. Clear everyone? Okay. Now I am doing option 1 first. Okay, option 1. In option 1, they are telling me that we take the entire money in form of equity shares. Okay. First I had 5 lakhs of equity share capital only. Okay, and now if I am doing this 3 lakhs of additional funds, I am doing it again in the form of equity, right? That means there will be no interest, nil. So my net profit before tax is going to become 2,40,000, same, minus tax. Tax rate is 50%, right? So 50% tax rate minus 1,20,000. My net profit after tax also will be 1,20,000. There is no preference dividend because see, there was no preference share capital in the existing. There is no preference share capital now in the new one also as per the option 1. So preference dividend will be nil. Therefore, this is the entire amount available for equity shareholders. Divide that by the number of shares. Now, how many number of shares? I had 5,000 already over here. More 3 lakhs, I am doing it in the form of shares. That means 3 lakhs Okay, that means 3 lakhs plus, no, 3 lakhs, I'll have to divide that by 100 rupees face value. So I'm going to have more 3000 shares. So total will now be 8000 shares. Clear? Okay, so the entire net profit, because there is no preference dividend, there was no preference dividend in the existing share capital, right? See, they have told no, that existing was only 5 lakh rupees, which is in the form of equity. So therefore there is no preference share dividend. So this entire amount, 1,20,000, is the profit available for the equity shareholders. Now that I will have to divide by number of equity shares. Only then I'll be able to get no earning per share. So how many equity shares do I have? I have 5,000, which was existing given in the question. See here, 5,000 was existing, and now 3,000 will be new shares. Why 3,000 new shares? Because I am raising a capital of rupees 3 lakhs. Face value of the shares is 100 rupees. Therefore, number of new shares which I will have to issue will be 3,000. So total will be 8,000 shares. Therefore, my earning per share is going to be rupees 15 in case of option 1. Okay, in case of option 1. You see, I have written 3 lakhs only in form of equity in case of option 1. Right? Now I am moving to the next option. They are saying that take 1 lakh in form of equity and 2 lakhs in form of borrowings, where the interest rate will be 10% per annum. Okay, 10% per annum. So let us understand this. Okay, total shares we understood. Now there is a means option 1 we are already done with. Now in option 2 we have combined. We have some amount in form of equity, 1 lakh in form of equity, and we have 2 lakhs in the form of debt. The interest rate is going to be 10%. So again, starting with my NPBIT, I told you that since we need the same return on a capital employed, NPBIT in all the options will remain same. So 2,40,000 is my NPBIT minus interest. Now here I will have interest at the rate of, what is the rate of interest given to us? At the rate of 10%. Okay, so 2 lakhs into 10% will be my 20,000 rate of interest. 2 lakhs is in the form of debt. 2 lakhs in form of debt. So 2 lakh into 10% here for debt. That is going to be 20,000. NPBT will be 2,20,000 minus tax rate is given to me 50%. So 1,10,000 will be tax. So my net profit after tax will be 1,10,000. Now again in option 2, okay, the option 2 which they have given, there is no preference shares. And I didn't even have existing preference shares that I am supposed to give them any dividend. Therefore, preference dividend is nil. This entire profit is the amount available to equity shareholders. Therefore, net profit for equity shareholders 1,10,000. How many number of equity shares I will have now? Existing I know 5,000. But I know that 1 lakh we have done it in the form of equity in this option 2. Therefore, how many more shares? 1 lakh divided by 100 rupees, which is the face value. So I am going to get 1,000 shares. Therefore, total number of shares is going to be 6,000. Therefore, earning per share, I am going to get it as rupees 18.33. Okay. This was our option 2, 1 lakh equity, 2 lakhs of debt. Okay, so earning per share we have calculated for both the options. Next, they are saying take full money in form of borrowings. Full money borrowings. Okay, fine. So same thing again. 2,40,000 is my NPBIT here. Now I am taking full amount in debt. That means on 3 lakhs I am going to pay 10%. That is going to give me 30,000 interest. Net profit before tax will be 2,10,000. Tax rate is given to me 50%. So I'll subtract 1,05,000. Net profit after tax is also 1,05,000. There is no preference dividend again over here. So nil. So this entire amount 1,05,000 is the amount available, net profit available for equity shareholders. Divide that by number of equity shares. Now in this case, the number of equity shares will be only 5,000. Only the existing which I have. I am not issuing anything new. There is no new equity share capital. So only the existing 5,000 will be my number of shares. Therefore, the earning per share is going to be rupees 21. See? Rupees 21. 3 lakhs only in the form of debt at the rate of 10%. Okay. Now the next one. Next option they are telling me 1 lakh in form of equity and 2 lakhs in form of preference shares. Dividend rate is 8%. This is the dividend rate. Okay, dividend rate. Okay, so we are going to start again same thing. I'll start with my NPBIT 2,40,000. There will be no interest in this case now. Why? Because obviously we do not have any form of loan over here or a debt over here. So profit before tax is 2,40,000. Subtract tax rate at the rate of 50%. Okay, at the rate of 50%. 1,20,000. I am going to get 1,20,000 as net profit after tax. Minus preference dividend. Preference dividend I will calculate on 2 lakhs of preference shares at the rate of 8%. So calculate 2 lakh into 8%, 16,000. Right? I am just writing it over here. Okay. I am writing this over here. 2 lakhs into 8%. 16,000 preference dividend. Subtract that 16,000. Net profit available for equity shareholders 1,04,000. That I have to divide by number of shares. How many number of equity shares I have now? 5,000 existing and 1 lakh is in the form of equity. 1 lakh is in the form of equity. That means I will have 1 lakh share, 1 lakh amount divided by face value 100. I am going to get 1,000 number of shares. So 5 plus 1,000, I am going to get 6,000 shares. When I will divide 1,04,000 divide by 6,000, the earning per share is going to be rupees 17.33. Now when you see this, all the earning per share, where is the highest amount of earning? It is in the option number 3, rupees 21. So option 3 must be selected since the earning per share in option 3 is the highest. Okay. So this was the most basic understanding of capital structure and how to find the best capital structure for a given expansion or need of more capital. Okay. Let us see another similar question. It is a calculation again of which is the best option. So let's see. Company Z has an NPBIT of 4,20,000. So existing NPBIT. Company has 80,000 shares of rupees 10 each. That means rupees 8 lakhs is their current capital. Rupees, right, in form of equity share capital. Okay. Retained earnings is rupees 12 lakhs. Okay. So this is their reserves and surplus, retained earnings. And debentures is another 10 lakhs. Okay, this is a debt debenture at the rate of 10%. Okay, so their total capital is going to be how much? It is going to be 20 plus 10, 30 lakhs. Okay. Now let us read further. The company proposes to take up expansion scheme for which 4 lakhs additional is required. It is anticipated that after expansion, company would be able to achieve the same return on investment. Very important. The funds can be raised either through a debt of 12% or issue equity shares at par. At par means at the face value, which is 10 rupees. Tax at the rate of 50%. We have to compute earning per share for both the options, and they have given me the market price as 100 for the share. I have to find their price earning ratio. Okay. For any sum, I will have to first find the new revised NPBIT because I want the same return on capital employed. Okay. So let's start. Question number 2. We have only 2 options. Okay, of this company, option 1 and option 2. Let me start with this first. Note. I told you the current capital employed equity share we just did know in the question only itself. So a current capital employed is 30 lakhs. NPBIT is given to me as 4 lakh 20. So what is my return on capital employed? 4 lakh 20 divided by 30 lakhs. Percentage. 14%. I need the same return. What is going to be my revised capital? On this 30, now they are saying I need additional 4 lakhs for this plan. So it is going to become 34 lakhs. On 34 lakhs, if we will do 14%, 4 lakh 76,000 will be my revised NPBIT. Okay, so for both the options, my NPBIT will be 4,76,000, 4,76,000. Option 1 is debt at the rate of 12%. Option 2 is equity share capital. Okay, 4 lakhs debt, 4 lakhs of equity share capital. Let us first do the debt. Revised NPBIT 4,76,000 minus interest. Now here pay attention. Okay, interest will be both existing plus the new. Okay, existing plus new. Now existing, in the existing plan, existing capital structure, already I have 10 lakhs at the rate of 12%. Okay, plus entire 4 lakhs which we need new, I am taking it in the form of debt. Rate of interest is same. That means interest over here will be calculated as 14 lakhs into 12%. Existing plus new. Okay, if the rate of interest are different, we will take 10 lakhs into whatever, 4 lakhs into whatever is the rate of interest. Your rate of interest is same of the existing and of the new debt. Okay, new debenture, 12%. So 14 lakhs into 12%, 1,68,000. Net profit before tax is 3,08,000. Tax rate 50% is given, minus 1,54,000. Net profit after tax is 1,54,000. There is no preference share capital, not even in existing, and we are not even taking in the form of a new capital requirement. So preference dividend is nil. So this profit is available for equity shareholders, 1,54,000. How many shares do I have? They have given me. Currently we have 80,000 shares of rupees 10 each. And the new 4 lakhs which we are doing, we are not doing in form of equity. It is totally in form of debenture, totally in form of debt. Okay, so there will be no new equity share capital, only existing equity shares, only the existing equity shares, 80,000. So my earning per share is rupees 1.925. Okay, second one. Second, we are not taking a debt. This 4 lakhs we will do it in the form of equity share capital. Okay, 4 lakhs. So NPBIT will remain the same. Interest will be only on the existing. Existing, I have how much of debt? 10 lakhs rupees debt at the rate of 12%. 10 lakhs into 12%. 1,20,000. Net profit before tax 3,56,000. Tax rate at the rate of 50% it is given. So 1,78,000 will be my profit after tax. There is no preference dividend again over here. So this 1,78,000 will be the profit available for equity shareholders. Divide them by number of equity shares. Now how did I get this 1,20,000? Already we had 8,000. We had existing 80,000 equity shares. Okay, and new equity shares I'll get how? 4 lakhs divide by 10 face value, 40,000. So 40,000 plus 80,000, 1,20,000 equity shares. Divide it, 1,78,000, divide them by 1,20,000. Earning per share is rupees 1.4833. Okay, 1.483. So which option will be better? Earning per share is higher in case of option 1. Right. So this is going to be better. Correct. Option 1 is going to be the optimal option, the best option amongst the two. They have also told me, but they have told me to just find earning per share for both the options. They have not asked me which option is the optimal. So earning per share for both we did. They are telling me market price of the share is rupees 100. So what is the price earning ratio? Simple. Price earning ratio, what is the formula? Market price upon earning per share. Market price they have given me. Market price they have told me it is rupees 100. So for option 1, earning per share is 1.925. So my price earning ratio is going to be 51.95 times. Okay. And option 2, my earning per share is 1.483. So my option 2 price earning ratio will be 67.43 times. Okay everyone, clear? So we are done with question number 1 and question number 2. Now let us go for another question, which is number 3. Okay. Company needs rupees 12 lakhs for a new factory which would yield an NPBIT of rupees 2 lakhs. Okay, they have given me. What will be the NPBIT yield? Means after this 12 lakhs for new factory, they are going to earn a profit before interest and tax of rupees 2 lakhs. And they have two options for this 12 lakhs rupees. Okay. They take equity share capital 10 lakhs, which is 100 rupees face value, and remaining 2 lakhs they can take it as a debt. Or 6 lakhs in the form of equity share capital and remaining 6 lakhs in the form of debt. Right? Cost of borrowings. If you are doing a debt, your borrowing up to 2,50,000 is 10%, and above 2,50,000 if you are borrowing, it is 14%. Tax rate is 50%. Earning per share we have to find, and price earning ratio is given. We have to find the market price. Okay. So let's begin. Now, two options are there. In first option, they have told me equity share capital 10 lakhs, debt 2 lakhs. Okay. And NPBIT is given to me as 2 lakhs rupees. Interest. What will be the interest amount? Working note I have done for interest. Option 2. Interest is 2 lakhs. Okay. Rate of interest. No, see here they have given a cost of borrowings up to 2,50,000 and rate of interest will be only 10%. So in my first option I am doing borrowing of only 2 lakhs because entire 10 lakhs is from equity. So 2 lakhs is up to 2,50,000, no? So 10% for option 1. So at the rate of 10%, 20,000. Okay. NPBT less tax rate 50%. Now this you all know. Net profit after tax is 90. There is no preference dividend at all. So this is the amount available for equity shareholders. How many equity shares I will have? I am having 10 lakhs in form of equity share capital. Face value of the share is rupees 10. So the number of equity shares is going to be, 1 minute. Okay, face value is 100, sorry. Face value is 100 rupees. Therefore, number of equity shares is going to be 10,000. 10,000 shares. Here I have written, see, 10,000 shares. Number of equity shares is going to be 10,000. I will divide them. Earning per share is going to be rupees 9. Price earning ratio is given to me. Given. Then what will be the market price? We know the price earning ratio formula. What is the price earning ratio? Market price upon earning per share. Now I have to find the market price. So basically what will be the formula? Market price. See here I am writing it again. See. Price earning ratio is nothing but market price upon earning per share. If I want to find market price, price earning ratio into earning per share will give me my market price. So that is what I am doing. I am multiplying earning per share with the price earning ratio. Market price is 90 rupees. Okay. Next. Option number 2, where equity share capital is 6 lakhs. If equity share capital is 6 lakhs, number of shares, okay, face value is rupees 100. Therefore, how many number of shares I will have? 6,000. 6,000 number of equity shares. 2 lakhs NPBIT they have given. Interest is important over here, okay, because they have given me a range. That if it is up to 2,50,000, take it at 10%, above 2,50,000, take it at 14%. Okay, so now interest rate for option 2, 6 lakhs in the form of debt. Up to 2,50,000, I will get at the 10%. So 2,50,000 into 10% is 25,000. So balance 3,50,000 balance. I will have to take it at the rate of 14%, which will be 49,000. 3,50,000 into 14%. It is going to be 49,000. Therefore, total interest will be equal to 25,000 plus 49,000, which is 74,000. See this, I have written. Okay, interest is understood, then everything remains the same. Net profit before tax is 1,26,000 minus tax at the rate of 50%. 63,000 is your profit after tax. There is no preference dividend, therefore amount available on net profit for equity shareholders is 63,000. Now how many shares? We just calculated 6,000. So I am going to basically divide 63 by 6. I am going to get 10.5. Divide 63,000 divide by 6,000. 10.5 earning per share. Okay, rupees 10.5 per share. Price earning ratio is 10 times. Therefore, 10.5 into 10, 105 rupees is my market price in option 2. Okay. So now we are done with question number 3. Alright. Let us just read question number 4. Okay. Following figures are made available to you. NPBIT is 18 lakhs. Interest on debenture is at the rate of 15%. Debentures were issued 3 months after the commencement of the year. Okay. Alright. NPBT is rupees 16,87,000. Less tax at the rate of 35%, net profit after tax. Number of equity shares, face value is 10. Number is 1 lakh shares. Okay. 1 lakh shares. Market price rupees 109.7 per share. Reserves is 12 lakhs. Company is examining a project of an investment obligation for rupees 10 lakhs. The investment is expected to earn the same return as before. The interest rate on additional borrowings will cost the company 300 basis points more than on their current borrowings on the debentures. You are required to advise the company whether should they take this whole money, rupees 10 lakhs, from loan or from equity. Okay, price earning ratio is given. We have to find market price and debt equity ratio. Okay. Let us start this sum. Okay, question number 4. I always want to know what is my return on capital employed. Now, what is my present capital? Okay, I need to understand my present capital. So, if you see your present capital, there is 2-3 things. There is debentures, there is equity, and then there is reserves. I am first trying to find out what is the value amount of debenture. How will I get that? With the help of debenture interest. Can you see this? They have told me interest on debenture is 15%, and this amount here, debentures were issued 3 months after the year had begun. That means this interest is only for 9 months out of 12. So if this is for 9 months, okay, then for 12 months, which will be how much amount cross multiply? 1,50,000 will be the interest amount. Okay, so say the face value of a debenture is rupees 100. 15% on 100 will be rupees 15 interest on each debenture. Okay, so this interest 15 is corresponding to total amount of interest is 1,50,000. So the face value 100 will be for how much? Cross multiply again to find the value of the debenture. 100 into 1,50,000 divide by 15, or simple, you can just do the interest amount upon the rate of interest. Interest amount is 1,50,000, rate of interest is 15%. So 1,50,000 into 1,50,000 divide by 15%, you will get 10 lakhs in order to find the value of debenture. Okay, so whenever interest is given and the rate of interest is also given, value can be easily found out. What is it? Value is nothing but value of debenture is nothing but it is interest amount, total interest amount upon rate of interest. How did I find my total interest amount? I know that 1,12,500 is for 9 months. So for 12 months it is going to be 1,50,000. Rate of interest is also given to me 15%. Therefore value of the debenture is going to be 10 lakhs. I have done this for your understanding. If I am giving 15 rupees as an interest, okay, per debenture it is 15, corresponding to value is 1,50,000. So per debenture is say 100 rupees face value. What will be the value? We are doing cross multiplication. So debenture is 10 lakhs. So one component of my capital is debenture. Next. Okay. So present I got, alright. I have reserves also. 12 lakh rupees, and number of equity shares is 1 lakh into 10. So equity share capital 1 lakh shares into 10 rupees, 10 lakhs. Debentures, we just did a working note on that, and this is given to me, reserves and surplus. So my total capital employed presently is 32 lakhs, right? On that I am earning NPBIT of 18 lakhs. So my return on capital employed is 56.25. Keeping that the same, I need additional 10 lakhs. That will give me 42 lakhs revised. On 42 lakhs, I have to take 56.25%, 2 lakh 36, 23 lakh 62,500 will be my revised NPBIT. I have to start my sum with this. Okay, so let's begin. Option 1, total loan. Option 2 will be equity. NPBIT, I found out. Okay, revised NPBIT, we just did it. 23 lakh 62,500, 23 lakh 62,500. In case of loan, amount of interest will be different. It will be existing plus the new 10 lakhs. Okay. So what will happen in case of the interest amount? Interest calculation for option 1, that is loan. I have done everything for you all. Okay. They are telling me that if we are going to go for a loan amount, okay, loan, form of loan, the capital, required capital in form of loan, the company will have to pay 300 basis point more. 300 basis point means 3% more. 100 basis point is 1%. Okay, so 1% is basically equal to 100 basis. So if I have to pay 100 basis point more on their current borrowings on debentures, means what? That now my interest rate will become 15 plus 3. They are not going to take 15 now. Even on the existing. They are telling me on their existing only, current borrowings only. They are going to have the current borrowings on the debentures will be at the rate of 18%. Okay, fine. Sorry, so the new debentures 10 lakhs is going to be at 18%. Okay, so 10 lakhs into 18%, 1,80,000, and the old debentures will remain 15% only. 10 lakhs into 15, 1,50,000. So 1,80,000 plus 1,50,000 is going to give me 3,30,000 for option 1. Once this is done, everything is simple. NPBT, tax rate is at the rate of 35%. Okay, you will get net profit after tax. There is no preference dividend. Amount available for equity shareholders. Number of equity shares is also given to me, 1 lakh. So my earning per share is rupees 13.21. Price earning ratio is 10 times. 13.21 into 10 will give me 132.1. That will become my market price. Okay, option 1 is over. Now I am doing option 2. Okay, option 2, NPBIT will remain the same. Okay, in option 2 it is equity. 10 lakhs is in the form of equity. Therefore, interest will be only the old interest, which is on 10 lakhs rupees at the rate of 10%. No, sorry, it is at the rate of 15%. Right? So this is done. I get my net profit before tax minus tax rate at the rate of 35%. I'll get my profit after tax. Preference dividend is not there. So this is the amount available or net profit available for equity shareholders. Now how many equity shares? Okay, come, let's see this. Now, number of new equity shares. Assuming, since they have given me the market price, assuming new shares are issued at the market price of rupees 109.7 per share. Okay, this is something new. Understand. Okay, if in the question also it is asked that the issue is happened at the market price. So understand, how much capital do I need? Capital requirement is 10 lakhs. Okay, divide that by the issue price. What is the issue price? 109.7. In order to find number of shares, always, okay, amount of capital required upon the issue price will give me the number of shares needed to be issued. So 109.7, this is given to me. So how many new shares I'll have to issue? 9,116. Okay, you have to approximately find it close to it. 10 lakhs divide by 109.7. You will get 91157. Okay, so it will be, 1 second, 10 lakhs divided by 109.7. Yes, you will get 9115.7. So you can do approximately, which is 9116. Okay, so total shares, old plus new. Old was 1 lakh, new is 9116. So total will be 1,09,116. That is what I have written over here. Number of shares. Refer to the working note. Okay, earning per share I can find out now. 13.17. 10 times is the price earning ratio, which is also given to me. This is all given to me. Therefore, market price will be 10 into 13.17, 131.7. Not much difference. Okay, in the earning per share, any option you take. Now, lastly, they are telling me find the debt equity ratio for both the options. Debt divided by debt plus equity. Generally, debt equity ratio is what? Total debt upon total equity. Right? Here they are saying find the debt equity ratio, but what will be the formula? Total debt upon total debt plus equity. Okay. So, option 1, what is the total amount of debt? Old plus new. In old I had 20, or in old I had 10. In new also I have 10. So total 20. How much was the equity in option 1? 10 lakhs. How much was reserves? 12 lakhs. So total was 42 lakhs. Total. The entire capital structure. Okay, in option 1. How much is the debt now? Debt equity ratio, debt upon the total. This total. Debt plus equity total we have to take. Okay, so debt is how much? Only 20 upon total is 42, percentage 47.62%. Okay, once again they are telling me to find the debt equity ratio, but they are saying that find it as debt upon debt plus equity. So debt plus equity I have already done over here for you all. Total debt is old plus new in option 1, because option 1 I have taken it in the form of debt, 10 lakhs. Right now. So 10 plus 10, 20, debt plus equity 10 plus reserves 12, total 42. Debt is 20, 20 divided by 42, debt equity ratio for option 1 is 47.62. Option 2, total debt is 10 lakhs. Equity is old plus new, 10 plus 10. Reserves stays the same. So 42 is the total. But your debt will be how much? Only 10. 10 divided by 42. 23.81%. Okay. So with this, we have also finished question number 4. Okay. So with this, I have completed your type 1 in case of capital structure, wherein we are supposed to find the optimal capital structure deriving the earning per share in each option and the components given for that particular capital requirement. Okay everyone, thank you so much. We will continue with the capital structure other types in the next class. Bye.